Hi, this is Mitch Kramer on our September 19th, 2024 webinar. Trey's not going to be joining me today because he just got great news and they delivered their third child about 24 hours ago, Miss Claire. So he's at the hospital with his wife and new baby girl. Everyone's doing well. He will be out on maternity leave for a little while, but he's been communicating with their office even though he's been in the hospital. Anyway, there's going to be a lot of information that we're going to cover today. Mainly, the Federal Reserve had a more significant rate cut than the markets had predicted. And this has more to do with the Fed realizing they're kind of been behind the timetable. The rest of the other parts of the world have been cutting interest rates because inflation has been coming down. So this 50 basis rate point cut, 0.5%, they probably should have done 25% in July and another 25% now. The markets did not do well yesterday. They did much better now, today, based on the news that's come out. I think the fact they've cut rates that much indicates the economy is not as well as you're hearing in the mainstream media. And a lot of the information that we've been talking about for many months is starting to become much more commonplace. So as we go through the webinar, the first part, the information that I'm going to present today is Fluent Financial. It's not private client services. So let's take a look at the market performance from the beginning of 2022 through today. And you'll see the S&P 500, this white line, has done pretty well. It's up about 18.5% for about a year and 3 quarters. Dow about 14. The equal weight S&P, the red line, is about 7.5. The Russell 2000 is actually negative. And what we're seeing happening is that the labor market continues to soften as inflation has come down. But you're seeing a rotation out of the big tech sector that's really been holding the market up for a long time into more of a diverse background, more defensive positions. And I think what you're going to be seeing happen going forward in the equity markets, that the big passive investing in indexes and their kind of leadership is going to start to be transferred over to individual picking of stocks and being much more tactical, where indexing will not perform as well. We've talked about that in past webinars. So the next slide we'll talk about is the leading economic indicator index. And we've been showing this slide for quite some time. As you can see here on the right, we are still deeply red and negative. And we've been talking about being in a recession or in the cups of one for quite some time now. This trend still continues that. So if we look at our portfolio's performance compared to the indices year to date, here's the returns. This is through the 13th. And here's our respective portfolios net of fees. We've been defensively postured all year. You're starting to see our T-bond ladder and our bond-heavy portfolios perform much better. And we have a lot of bonds in all our portfolios. V&O is sitting on about 25, 30% bonds. It's normally 100% stocks. And again, that's part of defensive posturing. When it makes sense to take more risk, we will do so, but we're not going to at this time because the economic conditions do not warrant it. The hope slide, we've talked about this for a long time. We're in the employment area. We're starting to see more weakness in that area. I'm going to go through the hope slides pretty quickly, but there's going to be a general theme you're going to see throughout all of the 4 categories, starting with housing. What you're seeing in housing is this downward slope, and 50s kind of break even when you have growth or contraction. We're at 41. It rose a little bit from 39 in August, but it's still a downward trend. And what's also disturbing is on the next slide, you look at housing permits. They're also continuing this negative slide down. And this is going to have an impact on industrial production, because when you buy a house, oftentimes you have to buy appliances, with refrigerators, dishwashers, air conditioners, those kinds of things. And consumers don't have the money for that, and they can't afford the higher mortgage rates. So you see this area continue to be somewhat weak. New orders on the manufacturing side, again, you're seeing this trend of moving northwest to southeast. And again, this is manufacturing. This sector has really been stumbling for quite some time. Again, the higher interest rates does not help. The consumers tapped out. So if we look at the supply area, you see the same trend, this negative trend downward. And it's above 50, but it's much more volatile. It goes up and down much more than manufacturing. But the overall trend is negative. Again, that just shows a slowing economy and weakness, and the Fed is aware of this. What we're starting to see, which is new this month, is on this next slide, profits. If you look at profits, and you look at this slide here, profits are earnings per share is this yellow line. Look, it just has fallen off a cliff. And here's the S&P 500. And what we're having happen here, I'm going to pick a better color. I'm going to go with blue this time. It's kind of like you have these shark jaws. And the shark's opening its mouth. You got the teeth here. And they're going to snap shut at some point. And that's when the recession starts. But you're going to see this pattern in some of the other charts I'm going to show on our webinar today. But basically, all of the earnings that companies were expecting at the beginning of the year have vanished. And that's going to have a negative impact on their stock price. We just didn't see it today. I think it's kind of a short-lived rally, but I don't think it's going to be long-lasting. So we'll shift to the last part of the hope cycle, and this is employment. And what you see here is both index of jobless claims and the continuing claims. And the unemployment claims only rose by 2,000. It's 230,000 for the week ending September 7th. The continuing claims are at 1.85 million. But I think the important thing to focus on is the slope of this line, where we've seen the slope of the lines in some of the other charts going northwest to southeast. These are going southwest to northeast here. And that's negative on this particular slide because when you look at the prior periods before recessions came into play, you see a very similar slope here. And we're starting to see that in employment breaking down. And again, we've talked about inflation is really going to have its back broken when we have a recession and the core services really start to cut prices. We'll show that slide here in just a second. Unemployment rate went from 4.3 to 4.2, 4.25, basically flat. There's a lot of people that are underemployed. I think probably we don't have this in this webinar. We've talked about this. The revisions of how many jobs are actually created continue to be negative, and the Bureau of Labor Statistics, BLS, has got a lot of egg on its face for really reporting incorrect numbers. And all of this translates into what's going on with inflation. And this is the problem coming out of COVID. The new administration, historically, Democrats are the party of big government spending. Now, Republicans are not immune from that. But what you see on this chart here, this white line represents the headline inflation. We're at 2.531. You're starting to see the core goods have deflationary pressures. Energy is now deflationary, which is this little red part. Food is somewhat stabilized, still at high levels. But the area that's still real sticky is the core services. So if you have someone come out to your house or get work done on your car, insurance costs, all those have remained elevated. And until we have a recession, it's going to be hard to see these yellow bars start to decrease. But you will as inflation continues to abate, and that will probably happen during a recession. So the next thing we want to talk about is the interest rate projections. This is a slide we show every month. And with the Federal Reserve rate cut, and Trey, to his credit, he was in the hospital with his wife Monday night, Tuesday. He actually did this work before he went in the hospital on the 16th. We actually had to update it today because we only showed a rate cut of 25 basis points and actually cut it to 50 basis points. So the Fed funds rate is going to be between 4.5% and 4.75. But what's important is the slope of this red line moving southwest. So you're seeing there are going to be a number of rate cuts that are going to occur, about 1.25 basis points this year, and they're expecting another 1.25% of rate cuts in 2025. If we have a recession, those rate cuts will come more steeply, which means greater rate cuts. And a question that I ask a lot of people in our service meetings, do you all remember what the Fed funds rate was prior to COVID? And the answer was 0 to 25 basis points. And we're at 4.5 to 4.75. Now, I don't recommend we take it down that low again, but that just shows you how far rates went up, and they went up at a very rapid pace. And that's what caused a lot of the pain we've had in our economy. The federal spending has kind of prevented the hangover from taking effect, but it's starting to happen. And speaking of the deficits, this next chart is a problem. Again, you kind of have the similar shark jaws that I'd mentioned before. You have the stock market here, and then the deficit, you have this hockey stick. I was looking on the TV today, and our federal deficit is now $35 trillion, $35 trillion. It's over 105,000 per American. It's incredible. It's going to have to be dealt with. And I think you're seeing some of the pressure on the long end of the bond curve is even though short rates have come down, which has helped the overall bond market, some of the longer bonds have not gone down over the last couple of days. And I think part of it has to do with this slide here. We talked about the problems in production. So if you look at what's going on here, this is European production. Germany's basically in a recession. You can see this downward slope that's going on production, very similar to our industrial production. Canada's in here as well. The world is really hurting, and we're going to have a recession. Just the question is, how deep is it going to be and how long is it going to be? But this just shows the industrial production problem. And retail sales, what you see here is that the U.S. consumer, it's basically been tapped out. There was a bunch of spending here with the COVID relief money, but people have blown through all that. And it is volatile. It goes up and down, but it's been very low, and now it's negative again. And this is important because 2/3 of the U.S. GDP is based on what we spend as consumers, and retail sales makes up a big part of that. Next slide, we're going to talk about returns 2024, what the returns have been by month versus the 30-year averages. And what you see happening is a very big disconnect between the returns this year versus what they historically been by month. And again, this is mainly being held up by the Magnificent Seven tech stocks. It doesn't represent the whole market, but you see this gap here, and it's not sustainable. On this next page, we'll move out a little bit and see how the price earnings ratios are looking for the overall market. And this comes from JP Morgan. The top 10 stocks, their PE is 28.3. The average going back almost 30 years is 20.5. So they're 139% of the average. The remaining stocks outside of the top 10, the numbers look a little better, but they're still elevated. 15.7 is the average, 18.4 is what it is. And then the overall S&P, you can see here we're 128% above average. So you can do some rough math and say we're going to have a 20 to 30, 35% decline to get the market more in line. When the market does go down, we don't know how much it will go down. No one does. But we do anticipate a correction in the marketplace. One of the economic measures that we've talked about is the SOM rule, and this is a very popular measurement tool the Federal Reserve looks at to see where is the economy at. And what's happened over the past 30 days is continued to rise above this 0.50 threshold, and every time it does that, we have a recession. So it's another statistic that shows we're not in great shape. And you may look at this and say, Mitch, this is all interesting. Why don't I see this anyplace else? Couple of reasons. First of all, this is technical information. A lot of your talking heads on TV don't want to get this technical. You may see it on CNBC, Fox Business, or Bloomberg, but you're not going to see it on mainstream media because it's too complex. And also it's an election year, and the politicians do not like negative news to come out when it's an election year. Another slide that's new that we haven't talked about, but it's real important. When you talk about a yield curve and a healthy yield curve, what you have here, I'm just going to draw this out for you. You've got interest rates on the x-axis, and you have time on the y-axis, and time's on the x-axis. So what you normally have is you have kind of this upward sloping yield curve, and that basically means that lower term rates or shorter term rates are lower and longer term rates are higher. This is a healthy yield curve. Our yield curve here in the red has been inverted, where the opposite has been the case, where you've got a situation where the yield curve has been inverted, where shorter term rates were higher than longer term rates. And that's not healthy. And that's generally a precursor of a recession. So where are we at now is, if you look at past recessions, here's 1991 here, here is the dot-com recession, and then here's the Great Recession 08 and 09. What normally happens is the yield curve inverts, and then we have a recession. Now, back here in the early 90s, it took a lot of time for it to hit. 2000 through 2002, it got here much sooner, and the same thing with the Great Recession. So this is a common pattern. So this kind of, you look at these and say, well, if it follows the common pattern, maybe we've got a few months before we enter a recession. Again, we're not smart enough, and if we were, you guys couldn't afford us. We don't know when the recession is going to get here, but we do think it's going to happen pretty soon. All right, so let's talk a little bit about the different sectors of the economy and what's happened since the market peak in July. So if you look at this, the tech sector, again, the Magnificent Seven, year-to-date returns up 21.28%. Year-to-date, now up about 14. They've actually lost about 7.4% during the 60-day period. But what's interesting is you can see this rotation, and other areas of the market have done much better. Utilities, for example, financials have picked up, communications, consumer discretionary, again, that's going to be the retail side. That's actually been hurt somewhat. So you're starting to see this rotation out of technology in other areas, and over a longer term, that's much more healthy for the market. But you have to know which stocks in these sectors are the ones you can be in. You can't just buy the index and be in the right sector. Long-term bonds, EDV is in a lot of our portfolios. That's the Vanguard Extended Duration ETF. That's represented by this orange line. And this shows the returns from mid-July until September 16th. And the September 16th, this light blue line represents the S&P 500. So the S&P 500 has been down about 1%, where the EDV and the longer bonds are up 11% over the same time frame. And this kind of goes back to what we had talked about in August when we had that swoon around August 5th and 6th, and the majority of our portfolios were up. Traded and Nick did a great job with their VIX calls and did some great trading, where a majority of our clients were making money when the markets were down anywhere from 3 to 6% during that same time frame. And again, our goal is to protect and grow your money in a very careful and prudent manner. We don't want to take risk. And with all this data, if we were to take risky positions knowing this, we wouldn't be acting as a fiduciary. So we're just very, very careful right now. Another sign of a market top or a blow off, as Trey would say, is, here's the S&P 500 on this mountain chart. You see it's going up at a pretty high level. But what we're seeing now happening is that the VIX index is starting to spike. So what that means is the market is very close to having a correction of some kind. I would think of it as a volcano. It's about ready to explode. We just don't know how big of an explosion it's going to have. But that's another indicator that the markets may be at a tipping point. And historically, September has been the worst month of the year for the stock market. Actually has a negative rate of return. And the second worst month of the year is October. So we haven't really seen that happen so far this month. But with the interest rates getting cut as much as they have and some of the noise coming out of the Fed, I think they're trying to cover their bases. And they're trying to engineer a soft landing. If they do it, I think it's going to be probably one of the best things the Fed's done in 70 years. I just don't see it happening. So we'll find out if I'm correct or if the Fed's correct. All right. So as we kind of wrap up, we look at our portfolio slides that generate cash. So many of you on this call are getting a paycheck from your portfolio. These are the targeted amounts, and $1 million. This is how much money we expect to generate. This is the trailing 12 months, what we actually have done. Advantage is still holding up very, very strongly. A lot of this can be legacy because of the very heavy tech indexes, because it does invest in the S&P 500 and NASDAQ, so it picks up the Magnificent Seven. Stock income is still a little bit below. It's 8% for the second month in a row. But what we've been doing for over 12 months is having at least 20% of that portfolio sitting in 30-day T-bills, and they're not going to generate as much money as a covered call on the individual stocks in that portfolio. Plus, the other thing that we've done with that particular portfolio, we've added the EDV long-term government bond position, which isn't going to pay much interest, but it's being used as a hedge and a trade opportunity. And stock income has had pretty good returns year to date and generating great cash flow. So I think it's done a really good job. So Trey and Nick have really done a great job for everybody. So that completes our webinar. I'll go ahead and open this up for questions. I'll go ahead and stop the recording.